Welcome to Winning with Annalee. I'm your host, Annalee Leonard, President and founder of Mainstay Financial Group on the corner of Cervantes and Perry. So glad to have you back with us today, and I'm so very glad to have Dr. Joan Connell back with me. We had a very long discussion last month about long-term care, what it is, what makes up that idea of needing long-term care. And we started talking about the cost, which we know can be devastating, and of course ways that you can protect yourself. So you can, and some people do, I have clients that have done this, pay from their own asset.
Right.
They have enough money to do that, and it's not a concern. However, you have to have a lot of money to be able to do that, especially if there is a spouse involved or anyone else who is in any way dependent on you, because it's very, very easy to use up that money very quickly and leave someone else destitute. So what I'd like to do today, Joan, if I could, is let's talk about the ways that someone can help to protect themselves from long-term care, and the fact that this is, as you have so often said, and I've heard you tell our clients that when they come in, you know, this is part of the plan. This isn't a standalone type thing, which is too often how I see this presented.
Yes. Mm-hmm. Yeah, and that's so true. The whole idea of long-term care protection, it's an insurance product. It is an insurance plan, and I always tell people we don't sell long-term care insurance.
No, we don't sell anything.
We don't sell anything, because what we do is it's not like you can just come in and buy long-term care insurance.
No.
Could you do that at other places? Sure. Can you do that at Mainstay? No, because long-term care insurance is part of a total plan.
Sure.
Maybe it's not for a particular person. Maybe there are other ways that are better for this person.
Well, and you know, we're talking about sometimes people protecting their assets, but some people truly, it's not ethical to put them into a long-term care policy because they don't have enough asset to worry about protecting.
That's right.
So you've got to look at that from both sides. You don't want somebody who's just out to put you into a particular product. Do you need it? Do you have the asset base to afford it, first of all? And are there other options for you? And that's things that you've got to look at. But I think one of the things we have to emphasize, and as you said, what we're talking about is insurance. Insurance is a transfer of risk.
That's right.
That's its definition. So in this situation, what you're doing is you're transferring the risk of you and the family having to pay for something to the insurance company paying for you. It's the same thing health insurance does and everything else. But the most important thing I think people have to realize, and this is what we see, people very often put that planning off too long. It becomes too expensive, but even worse, they've waited so long that their health doesn't allow them to purchase long-term care insurance or to integrate it into part of their plan. And I see this often. We both do.
And you know, just a couple of weeks ago, I had a woman come in. She went to one of the seminars I did, and she was very concerned, excuse me again, about having long-term care insurance. We sat down, and financially, it did not make sense. It didn't make sense for her. But she left knowing that, oh, at least I've got that question answered, and now I know what I would need to do should this need arise in the future. Right. Another thing that happens is we want people to start looking at this total plan in their 50s, because we know that the younger a person is, the better chance they have of not having a health issue that will knock them out of getting this kind of protection.
And the less it's going to cost them.
And the less it's going to cost them.
The less it's going to cost them, because all insurance works that way. The younger you are, the less the cost. And I've done figures on mine, because I've had mine for years and years and years. You know, for what I pay in a premium, if I needed long-term care, let's say 5 years from now, what I would spend in 1 month would cover what I've spent in all those premiums.
Absolutely.
I mean,
absolutely.
Hello,
That's called
talk about transfer of risk.
Right, the break-even point. And so often people only think about the cost of their premium. And you know what's amazing? Our house insurance. Okay, if you have a mortgage, you have to have house insurance. Right. But if you pay your mortgage off, do you give up your house insurance?
I don't.
I don't think so. Not very many people do. What's your chance of having a fire? 1 in 1,200. What about car insurance? Okay, we need it. We have to have it, technically by law. A chance of a car accident is 1 in 600. A chance of needing long-term care?
Didn't you say 1 in 3?
Well, actually 1 in 3, 1 in 4, but over 65, it's 1 in 2.
Yeah.
It's
so,
1 in 2.
You know, statistically, when we look at this, it's something probably, and that's all life is. Life is probabilities. So then we sit down and we start talking about, all right, if this is suitable for you, that's number one, if it's suitable. Number two, if your health will allow you to purchase something.
Right.
Let's look at all of the other factors that directly affect the cost. And sometimes, again, when you have people that are kind of what I call product pushers, they try to get you into something without explaining all of the different options. So, you know, if I come to you and I say, Joan, I want my benefit to last me for 5 years, there's going to be a pretty big different cost than if the person right behind me, same age, comes in and says, I want a benefit for 3 years.
Right. There'll be a difference. And those are all the kinds of variables that we sit down and we look at with people. And one of the other things we look at now, and that the insurance companies want to be looking at, is your family history.
Yes.
Because if, you know, we didn't used to look at that. We would look at it to help people kind of plan for the future. But now even the insurance companies are looking at that, saying, do your parents have Alzheimer's?
Yes.
Did one of them have Alzheimer's? You know, and they're looking at that because that's going to increase your risk.
Sure.
And they look at that. They know that from their statistics.
And they want to look at those things. So, and then we want to look at how much do I want the policy to pay me.
Right. How?
You know, if I've got enough asset, I can supplement. I may not need 150 a day or 200 a day. So that's another thing that you look at. Right. And one of the things I think people, oh gosh, most often overlook is to protect themselves against inflation.
Oh, this is...
you know, and I teach this in the classes, and I'm going to ask you to do this. Write down on a piece of paper right now what you paid for your very first house. Now right on top of that, write down what you paid for your last car. See, that's inflation. When I look at what I paid for my last 5 cars, that was much more than I paid for my very first house in Metairie, Louisiana. It creeps up on us, and what years ago might have cost $50 a day, today is going to be costing $150, $200 a day.
That's right.
So, got to protect from inflation. Male or female, doesn't that have an effect?
It does now. It does now. About within the last couple of years, the insurance companies have realized that women are going to be using this for more frequently and perhaps longer than men do.
Because we live longer.
We live longer, and we're generally more healthy, so we live longer, and then we're going to use this. The risk to the company is higher. So therefore, they decided that women, for the same exact benefit, will pay more than men.
We're going to pay more. Doggone, they get us all the time.
That's right.
Yeah, so you have to look at what is your ability to pay. I mean, you know, I would love for just once to, maybe for a year, have a Maserati that I could drive around just to say I drove one, okay? Could I afford it? No.
No.
For me, that would be a foolish spending of my money. So you've got to put it to what is your ability to pay. Don't look at the, you know, the Maserati plan, if maybe we should be looking at the Cadillac or the Mercedes or the Ford. It all depends on what you can afford, but no matter what you do, it will be a help to the family, and it will be a help to those that are around you. So is saying that, you know, and we've got a lot of different ways we can cover this. Let's talk about some mistakes people need to avoid.
Oh, that's very interesting, that when people are looking at this kind of coverage. First of all, one of the mistakes that people have to avoid is they either get too much or too little coverage. If they get too much coverage, if they get more coverage than they need, they're going to pay a higher premium. If they don't have enough coverage, and I've seen this with people come in who purchased policies 20 years ago, and the agent put them in a policy that pays $80 a day. Well, $80 a day was good. You only had to pay $20 extra, you know, to make up the difference for the day. But now, like you said, $150, $200 a day, now you're going to have to add out of your own pocket $120 because they did not urge them to get inflation protection.
Yeah, and you know, when you talk about that, you might be talking about a small difference a month in a premium versus trying to show up with $120 a day.
That's exactly right.
It's a very, very big difference. So you don't want too much coverage, you don't want too little coverage, and that's where it all goes back in making it part of the plan, the entire plan. What do you need?
That's right.
What do you need?
And how is it going to fit? How does this fit in? Another big mistake that people make is if they get inflation protection, they might get the wrong kind. And you know, we have two types. One is 5%, well, one is simple inflation protection. And one is compound. And one is compound. So the compound one grows more robustly and more quickly, so your benefit amount increases more quickly. Right. If you get one that does not increase enough, it doesn't keep pace with inflation. So, and the younger you are, the more critical it is to have compound inflation.
To have that inflation
because it might be 25, 30 years before you use this.
So I think the main idea we're trying to reach everyone with and get to everyone is this is part of a plan. It isn't a simple process. I wish I could say to you it is, but there's nothing about this process in choosing what fits an individual that's simple. It should never be taken as a standalone. It's something that is part of your entire financial plan, and it should always be addressed when you're looking at your financial plan and your future, because it's part of what happens. So when we come back, we're going to talk about a couple more mistakes that people very often make and how we can help you avoid those.
So, I'm kind of new here, but I've noticed a trend. My human does this funny thing where she goes around and gets all my toys, and then she hides them in that basket by the door. It's like, hello, that's where you put it last time. You were the worst at hide and go seek.
Mainstay Financial Group offers advocacy and personal financial guidance in a caring environment. That's the heart of our practice. At Mainstay, we're dedicated to exemplary service and a caring relationship with our client, not with a number. Plan for the future now with Mainstay Financial Services.
When you're finished with your food or beverage cartons, toss it in the recycling bin. Because every carton is recyclable and can be turned into useful paper products. Put your carton in the bin with your other recyclables and let them start a new life. When the contents are gone, let the carton live on. Recycle your cartons.
Welcome back to Winning with Annalee. I'm your host, Annalee Leonard, and I have as my guest today Dr. Joan Connell, my business partner, who is also our long-term care and Medicare specialist at Mainstay Financial. I want to point that out, Joan, before we go any further, and let you know why we structured our business the way that we did. We live in an extremely complex world today. Things are changing on a consistent basis. I'm very good at what I do on the financial side, at putting plans together, helping to implement those plans. But that is a full-time, 24-hour-a-day, 7-day-a-week job in order to stay current with
right.
what's going on. What makes me nervous now is sometimes I look out and you have a person who is doing property and casualty and doing life insurance and doing long-term care and doing annuities and being a bank, and I personally don't understand how they can keep up with that. So when we asked Joan to come in and be part of the firm, I very specifically said to you, I want you to do the long-term care, the Medicare, the Medicaid. I want you to be my expert on that. Because how many times in the past few years have these products changed?
Oh, they change all the time.
All the time.
They do.
All the time. You know, it's just like people think they read about IRAs. I know about IRAs. No, you don't. They change. The laws change. So you have to be studying, you have to be implementing. So when someone comes in to visit with us, and that's what Joan's saying, it's part of the plan, we look at the financial side, then we look at that side and see, do those two meld together? And if so, then what is the best plan?
Right.
So with that said, we were talking about some of the things that are mistakes people make, and of course we hit on one of those, waiting too long. That can either be, you know, and let's face it, the older you get, the more these plans cost. So if you're too old, people might want it, but they can't afford it, or the health is deteriorated.
Yeah, and that's, you know, those compound each other, obviously. And certainly people need to know that these companies all have ages where they cut off even giving policies. You
they
know,
stop.
Right, where I can take an application. But be that as it may, the most important thing is, I would say, health. Because even if you want to pay anything to get this policy, if you're not healthy, depending on what the conditions are, you might not be able to get a policy.
And then just like any other health policy, there are going to be some discounts. If you're healthy, you're going to get a preferred rating. If you don't smoke, you're going to get a better rating. Right. If you're a couple, you get a better rating.
Yes, that's very true, very true. Couples often get substantial discounts when they apply together.
Because they know that statistically one is going to help take care of the other before claims are made. So couples do get discounts, and if you want to make sure that you do talk about that. One of the things you have in here I really think is very, very important, buying on price alone.
Oh, yes.
Oh, gosh, so many people do that and make big mistakes.
That's
big
right.
mistakes.
Don't shop around for the cheapest long-term care policy. No. Don't shop around for the cheapest any kind of insurance, really.
No.
Because if you're looking for something that is cheap, you might not be looking at the rating of the company. And company ratings are very, very important for consideration when you're buying any kind of product from an insurance company. You want to make sure it's a strong, solid company. And over the last several years, we know a lot of companies have left the long-term care arena. They're not issuing new policies. The companies that are left are the ones with pretty strong track records and large reserves, so that they can afford to pay their claims.
And that's an important thing. You know, that's one of the things I talk to my clients about when we're on the financial side. If we are using some assets into an annuity base, one of the things I tell them, one of my reasons of choosing companies is that company's solvency. Can they pay their claims? So always be very careful if like an annuity company is offering too much up front, or if a long-term care company is too inexpensive. It's very often because they're trying to get dollars in to build their cash reserve, because the cash reserve is too small. So I always advise people kind of look at the playing field, and you're going to be within an average somewhere. If anybody's too far this way or too far that way, those are the people we need to avoid. There's something there that's not quite right. So please be very, very aware with that. You also put a point in here, and I think it's important, working with the wrong agent. What do you mean by that?
Well, what I mean by that is you need to work with the right agent, which is me, of course.
Of course, that's you.
What I really mean by that is look at an agent who specializes in this kind of protection. As Annalee mentioned before, she specializes in what she does. because she can't keep track of all the changes that take place in every arena. So that's why you need to work with somebody who does this pretty frequently, or at least keeps up with the changes that are happening. The other thing is, I tell people, look at working with an agent who is an independent. You can work with an agent who represents only one company, but if you do that, you need to go to several different agents who represent different companies, so you get different quotes and different ideas of what those policies cover. Don't just take the word of one particular agent. And I see this often happen at in some places where people do what you do, Annalee, financial planning, and then they have one company that they use for long-term care. Well, of course, everybody's going to be quoted that. And it might not be, A, the most suitable for you in terms of your needs, and it might be more expensive than it has to be. So always work with someone who is an independent, such as we are at Mainstay Financial.
Well, let us do the shopping for you.
Yeah, that's what we do. We do the shopping.
You and I both do that. When I do life insurance, I get on the computer and I'll get quotes from 200-300 top companies, and then call those down to 4 that give the best premium, have the same equal type of rating, same solvency, and then show you what we've come up with. And I can do that a lot faster than you can go through a couple of hundred companies. Same thing, Joan can go through 20 long-term care companies much more quickly than you can and show you the differences and the comparisons. And that gets down to one of the things you and I were talking about yesterday. If you have a good agent, when that policy is delivered, they will go through that policy with you and show you the fine print.
That's right.
Because you know what they always say, the big print giveth and the small print taketh away. So you want to know what it says. What if I'm going to make a claim 10 years down the line, what do I have to do? Like my own policy, you've pointed that out to me in my policy, if I were ever to go into an assisted living facility, that facility has to meet certain criteria before my policy will pay. And to me, that's a good thing. If I have to go somewhere, I don't want to go somewhere that's not going to meet the standards of health care. You know, a lot of the policies will say they have, what do you call them, a coordinator?
A care coordinator.
A care coordinator. So if you need care, you call them and they help walk you through a lot of stuff.
Planning, making the plan for the help. What's the best way to get your care. The other thing, Annalee, that I want to point out too is going back to working with the right agent. You know, we had this happen a couple of weeks ago. You had a client come in and she was very concerned about long-term care. Very concerned. And so I sat and met with her and her husband, and he was not eligible for long-term care for his own reasons. But as I sat with them, I realized, and asked them questions, I realized that he was a Navy veteran. He had a Navy retiree. And when I heard that, I said, oh my goodness, that means that your wife is eligible for the federal long-term care program.
Which they didn't even know existed.
They had no idea it existed.
Didn't even know it existed.
And I was able to actually show her the same exact benefits, and with an individual policy and the federal long-term care policy, and the premium was $2,000 less a year. Now, that's the importance of dealing with someone who looks at the total picture and listens to everything your client says.
And she was a very happy camper.
Oh, she was thrilled.
She was a very happy camper.
Who wouldn't be if you saved over $2,000 a year? That's right.
But, you know, and those are the things you want to look at. Are you eligible for federal benefits? Are you maybe still working and have a group plan, which is a good thing. Some group plans, a little scary, but some group plans are very, very good. And that's why we tell everybody, if you're going to come in and sit and talk to Joan and I, bring those options with you. Let us look at them and we'll compare. And if it's good, we're going to tell you, please go take that. That's going to be a better thing for you to save you money, give you the same types of things.
That's right. And you know, we're always about educating people. And we want you to be as educated as possible as well. And we have these guides that are from Kiplinger, and they're provided through the American Association of Long-Term Care Insurance. And if you call our office at 437-3127, give us your email, your name and your email, we'll be glad to email this to you, as well as long-term care planning, a different idea. And then we have valuable lessons on long-term care planning for younger people. So those things are available for you to take a look at. We would love to send them out to you.
So it's a very, very complicated world out there. A lot of choices for you. My biggest suggestion I can make to you, your money, your long-term care protection, your legal matters, your health matters, your tax matters, work with a team that's looking out for your good. Work with people you feel comfortable talking to. Work with people who are listening to what you have to say. That is the most important thing I can convey to you. What I'd like to do, Joan, I know, gosh, we've already covered 2 shows doing this, but we have not even hit on the different ways today that you can help protect yourself, what we call traditional versus hybrid types of coverages. I hate to impose on your time, but I'm going to ask you to come back again, because I really think this message is so important to get out. I want to spend time with you talking about the different types of coverages and how there are some things out there that cover more than one need. And to me, if I've got one tool that can cover 2 to 3 needs, that's a perfect tool. We look forward to seeing you. Call us at 437-3127. We'd love to set up a complimentary consultation to serve you however we can. Thank you.